Okay, let's get into your pro picks now, your best ideas in this market. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, so you've brought your three best ideas. To recap, you are somebody who looks for areas of risk. Right now, you say the best play is to move into hard assets and tech is poised to underperform. Yeah. So is it any wonder that your first idea essentially is to short Nvidia? And you can do this through a product. It's an ETF that shorts Nvidia for you and puts on some leverage. So if Nvidia were to fall, you wouldn't just capture that downside. You could potentially capture more than that. Is that a good way of explaining it, Larry?
Well, yeah. Remember, this is kind of like more entertainment than all because, levered ETFs are dangerous and they have an embedded decay, right? So if you buy a levered ETF, and say you put whatever it is, $100,000 into a levered ETF and the stock goes nowhere for a year, you're going to be down probably 9 or 10% just by the decay of resetting the portfolio. So it's a very dangerous situation to be long, say, a levered ETF. But the point we're trying to make is the energy bottleneck situation. And so what we're seeing is clients that are actually getting long some energy plays and short Nvidia against it because the energy bottleneck situation is so profound, the probability of that happening, that it sets up a big risk to Nvidia. You got 28 times sales. Think of Microsoft, right? And think of Apple. And so once you get above, say, $2 trillion, $3 trillion company, Apple's trading at 8 times sales, Microsoft 13 times sales. You can't have a 28 times sales company at $4 trillion. It's very difficult to make money at 28 times sales when the other Mag 7 companies are all trading at either 8 to 14 times sales. You just need a perfect execution path. And then if you look at the Avago news from last week, the moat. Now, the big argument around Nvidia is their impenetrable moat, right? And if you listen to anybody from Harvard Business School, they'll tell you about, that moat. And all that is setting up kind of barriers to entry, monopolistic type power, allows, tremendous profits. But it's pretty clear that Nvidia's moat is cracking. And it's also pretty clear that the probability of bottlenecks in the energy space to support artificial intelligence growth and all those data centers, that's also coming in very, very fast against Nvidia. And so at the end of the day, we're short Nvidia.
Yeah, I'm glad that you said that about that ETF because I was going to beat up on you for buy. So it's really just an illustration, short Nvidia and maybe against a long, and we'll talk about that in your second pick. But I want to go back to this idea of Nvidia does fall, and sometimes it falls 30% over the course of a year, and sometimes it falls, as much as 60%. Nobody had a nice time in 2022, Nvidia included. But if you're a long-term shareholder, not even long-term, in 2 years, the stock's up 1,000%. How do you recommend a short like that when fine there are cracks, but Nvidia is really the only game in town?
Yeah, so I just look at, like we talked about earlier, the thing about Bitcoin and, say, Michael Saylor and that whole crap, they've destroyed a lot of investors because at the end of the day, since 2017, you've had 4 drawdowns of 80%. 80%. 4 of them, right? And like I said, the average person, you see all these jerks on Twitter holding up these long-term track records. It's complete garbage. At the end of the day, what happens is, like I said, a young couple, they're building a house. They've got some money invested in the market. They're all of a sudden they're down 50, 60, 70% for like 2-3 years with, say, Bitcoin that was down there for 2, 3, 4 years. They just don't buy and hold. It's very difficult. Look at gold. Gold's biggest drawdown the last 10 years, gold biggest drawdown, 22%. That is a preservation. That is a store of value. Only 22%. Whereas the biggest drawdowns for Nvidia and Bitcoin are in that 70 to 80% bucket.
So you mentioned, maybe short Nvidia, go long energy. And one of the areas of energy you're going long right now is natural gas. You're expressing that through, there's so many equities that you could look at: Long Range Resource Corp, Antero Resource Corp, First Trust, natural gas ETF. Let's talk about the thesis. Why natural gas?
Okay, first of all, Amber, one of the things we love is when you have a sector where you kind of have what we call a hot money flush just occurred. And what we mean by that is if you talk to investors around the country, we talk to a lot of institutional investors in our Bloomberg chat behind us. And remember, that's what our book's all about, how to listen to markets speak. It's about gathering the intelligence from great investors. We sit down with David Tepper. We sat down with David Einhorn in the book, Charlie Munger. So we're constantly looking at the large investors and what they're talking about and successful investors. In the natural gas space, the big consultants this year were talking about a very, very hot summer in the Northeast. And anybody that was up on Cape Cod or New York or Boston this summer, you know how cool it was relative to previous years. And so natural gas itself was really, a lot of people try to front run that expected hot summer because of all that air conditioning demand. And so you had a big move up and in a real nasty, what we call a hot money flush. So the natural gas equities like Antero and Range Resources are essentially down 33, 35% off of those spring highs. And these companies are buying back stock at the fastest pace in the history of these companies. So there's a real bid in there under the surface. And they're trading at what we call 10 to 15% free cash flow yields. That all that means is they're producing so much cash flow, they're buying back the stock. They can do a lot of things with that stock to that cash flow to support the equity price. And you've just got great valuations trading at 2 to 3.5, maybe 4 times EBITDA. And so great valuations, but also look at Meta, look at the hyperscalers. The only path to the green meadow, and that's what we call solar and wind, the only sustainable path to support artificial intelligence, to get to that green meadow, which is way out in the future because we're just nowhere near our artificial intelligence being supported by wind and solar. The only path is through natural gas. So I love I love a sector where you've got great valuations. The companies are reducing debt, strongest balance sheets in years, great valuations, but they're also on the precipice of an incredible bull market powered by natural gas demand from artificial intelligence.
So again, I asked the question, do you want to hold natural gas through that ETF or do you want to own the equities? The equities at least have a better longer term track record, and nat gas, it's really cyclical.
Yes, well, one of the problems with the natural gas ETFs like the UNG is they constantly are rolling the contracts. So say you run the UNG ETF, which is the natural gas ETF. They have to roll the future. So this month future expires, they buy the next one. There's a cost to that over time, and it can get pretty costly. The FCG ETF, Frank Charlie George, is long a basket of natural gas companies and pipelines. What's fascinating about the FCG ETF, Amber, the top 3 holdings in the FCG are only worth $250, $270 billion, top 3 names. That is a fraction of Nvidia. Nvidia's once again at 4.1 trillion. So you can buy the FCG ETF. All the stocks in there combined are a fraction of Nvidia's valuation. It's a great buy.
Your third one is pretty interesting. It's coal. I don't know the last time I've had somebody come on and say, look at coal, because isn't that a dying energy source?
Yes, it is. But what we've noticed is over the years, there's been 3 or 4 times where coal was carted out. Remember, the coal ETF, KOL, it got so bad for coal that that ETF had to shut down.
Yeah.
So we have had many periods in time, but the coal names in recent years have they've been with multiple periods where they're destroying tech. Not this year, but the coal names are a great value. CNR equity trading at 3 times EBITDA, great free cash flow yield. It's the old Arch Coal, and remember, Arch Coal, you've got met coal, which is for steel, and then you have coal that's producing power for the plants, right? And so artificial intelligence, the demand on power is going to be so great. It's going to be explosively supportive of coal. There's just no way of getting around coal. There's no way. And so we love the valuation. And we also like the fact that a lot of the hot money came in on the Trump win in November. Look at CNR equity, Charlie Nancy Robert. Or just look at the new coal ETF, the COAL. We were really hammered here because a lot of people bought the coal names into the Trump win, thinking, Trump, what's he call it? He calls it big beautiful coal, right? So you have a very supportive White House. You've got a sector that's been hammered, trading at amazing valuations, once again into that artificial demand for energy. And so that's just another great way to play artificial intelligence. Every Tom, Dick, and Harry is in Nvidia and Meta and Microsoft. Any moron knows that's an AI investment. Nobody's doing the math on the real best risk reward in artificial intelligence, and that's the power sector.
All right. I love it. Coal is the AI trade. Larry, always fascinating to get your perspective. Thank you so much for taking the time and joining us this hour.